All right, we are live. All right, we're gonna get going here. I want to thank everyone for joining us today. This is going to be a fantastic episode. We have a special guest today. We have with us Clinton Donnelly from Crypto Tax Audit here. I'm incredibly excited to have him here because we have a presentation. I haven't met him before, but this is the first time we're meeting. I followed him on Twitter, and luckily he hooked up last minute thing. So, Clinton, I want to welcome you to the show first. And so, tell me a little bit about because today's topic we are going to be talking about these letters 6174, 6174A, 6173. So, you have a lot of experience in these letters, correct?
Oh yeah, and this is a super hot topic in tax law today.
Yeah.
Absolutely.
Yeah. So I mean, you've been doing this for a while. I have, and honestly, I haven't been doing too many of them because I've been in the offshore, the expat world. But as I'm going to say, what's interesting is now you're seeing the collision of the two worlds, and I think there's, we were talking about this show that we're seeing a lot of overlap between expat taxation, international taxation, and crypto. Can you explain a little bit what you mean by that?
Okay, well, let me give you a little background about myself first.
Oh yeah, right.
We've been my company. We were doing expat tax returns, voluntary disclosure returns. We were doing that through 2019, but starting in 2018, we started doing crypto tax returns. These are a crypto tax return is a regular tax return where you have to report your cryptocurrency income as capital gains or other income. But it doesn't stop right there. There's anti-money laundering forms you need to file at the same time, and we were helping clients do that. Starting in 2020, I offloaded all my clients that were just expat and only focused on cryptocurrency clients. We have clients in 71 countries around the world who call up for consultation. Here's the interesting thing. And here's why there's a significant overlap between expat and cryptocurrencies. People that invest in cryptocurrency fundamentally have a disbelief in the U.S. monetary system. They don't trust the government. Interestingly, these are the same things a lot of people living overseas feel. So there's a lot of intersection on that. And the next element is that when you invest overseas, well, typically when you do banking or brokerage in the US, you stay in the same bank. You stay in Fidelity. You buy your stocks, you sell your stocks. You don't go anywhere else. But in the crypto world, it's different. What we call on-ramp. That means we take our fiat and we buy a cryptocurrency at a US exchange. So like Coinbase, right? That's the US. Coinbase, Kraken, Uphold. These are some of the US exchanges. But we don't trust the exchanges to hold our assets. They're not guaranteed, so we move them off to private wallets. It's basically a USB stick that you personally carry. And then at some point in time, you might want to trade it for those coins. Let's say you bought Bitcoin. You want to trade that Bitcoin for another coin, like say Ethereum or Solana or any of 1,000 other coins. Well, you might go to another exchange, an exchange that's not in the US, to do that exchange of coins. So you actually exchange one token for another token, and that's different than when you're doing stocks, right? So if you're on Fidelity and you have Google stock and you like to say, I want to get rid of it and buy Apple, you basically liquidate the Google stock. It goes to cash in your brokerage account, and then you buy the Apple stock, right? Two-step process. But not with crypto. I go straight from Bitcoin to that other coin. It's a direct swap. Yeah. Right. And in the crypto world, actually, Bitcoin is like the common denominator for everything. So a lot of people don't think that's a taxable event because they never went to cash. But in fact, you did experience some gain or loss in the fair market value in U.S. dollars at the time of the trade. So you did that. And if you were trading on a foreign exchange, do the FBAR laws come to bear? Do the FATCA laws come to bear? Do you have to file an FBAR? Do you have to file an 8398 to did I say it right? 8938.
8938, yeah.
Yeah, I get it backwards.
Yeah.
38.
Yeah.
Do you have to file that? And as you know, the 8938 is an interesting form. If you should have filed it and you didn't, then your tax return is considered not filed, and the statute of limitations never starts. All right, and they could keep that open for decades if they wanted to. So that's where this is where there's a lot of intersect. Here's the real big problem with crypto traders. Our statistics, and it's corroborated with the IRS. In fact, I think the IRS got the number from us. Is 75% of most crypto traders aren't reporting any crypto income on their tax returns.
Oh wow.
particularly
wow.
if they're expat. So
Yeah,
so
yeah, and I think,
big
yeah.
exposure.
We definitely have it. Well, John, the great John Richardson. Thank you, Chris. Thank you, Clinton, for your introduction and everything. Appreciate that. The great John Richardson did hop on. John, we have a special guest, in case you haven't noticed. Welcome aboard, John. And I think we're gonna find some exciting things today. We're going over the many of the similarities between expats and crypto investors, and then a lot of times they are the same person. They are expats doing crypto overseas, and it's very common because those same things that make someone want to get into crypto are the same things that make someone say, I don't know how good in the United States of America. I'm not sure how exceptional in a good way we are. So we're going to get it out. I have a little bit of a presentation to go over with. And I do want to give, so John, good morning to you. Let me just give you excited about today. This is going to be a lot of fun. I have something for you a little bit. We'll get into it. You're going to like it. And then we have Keith Redmond with us. Keith, welcome to the show. Keith is the formidable Keith Redmond, helping out so many expats around the world. Keith is crypto. Now, Keith usually helps out. It's usually spouse or it's married couples where one spouse is not U.S. and one is U.S. Keith, do these crypto's issues are coming up for the people that you're talking to? Do they ever mention crypto investments or?
Yeah, I deal with people with so many different situations and nuances. I'd have to say maybe one or two have dealt with crypto, but generally speaking, the people with whom I speak, they don't.
Yeah.
So today's going to be a learning day for me.
Right on.
Gentlemen.
Well, I would say it tends to be. I notice it tends to be Gen X and below. That it tends to be the crypto investors are all my youngest. They're all my youngest clients.
That makes sense because the people with whom I speak are older. You know what I mean?
Yeah. Yeah, so it's generally. All right, well, we're going to get in the presentation. Let me get it up here. Let's present this here, and let's go into here. So we're going to get this, and so this is what I have on it. This is what I found on it so far. So IRS Letter 6174, okay, so just some history. It went out in 2019, 10,000 taxpayers. Does that sound about right to you, Chris?
Yes.
Yep, okay. I'm sorry, Clinton. Sorry, Clinton. And now this is the thing, and it's really IRS Notice 2014-21. That I think is really the pivotal notice, because that's where we get the law that a currency is actually property. And I think, and I was using my John Richardson skills of analysis to take a look at things. And so I want to see how I did on my analysis as we get to the statutes to do some examinations on this. So that's the letter that comes out, and it's pretty scary, I got to say, when you get it. And let me try to get up a sample one here. I'll get to a sample one in a little bit here. Now, this is what got me. This is what got me when I looked at the letter. We got a soft letter from Large Business and International, because you can get it from various divisions. It's not one division of the IRS that will send it. Now, what got me was that the letter my client got was from Large Business and International, and it was interesting because, well, he did happen to have a crypto account in Australia. So it was like, okay, that is appropriate that you send them it from Large Business and International. But how you getting that information? Now, in this case, there was a criminal indictment, so it's possible it got through that way. But one of the things that we've been talking about is that there's a massive amount of FATCA data that has been shared with the U.S. government. What we're told is that it's all in an unusable format, that it's comes in a non-standard format, and they don't know what to do with it. And something I've been saying for many, many years is, wow, that's a perfect application of AI to go through that, sort out, to get usable. I mean, that's what I'm saying. Like, hey, look, it's there. And as you said before, Clinton, if that 8938 isn't filed, or 5471, if you're missing some of these reporting filing requirements, your entire return remains open forever. And I got to tell you something. One of the worst things is being audited for something that's happened 15 years ago. I have encountered it. I have encountered someone who didn't file 5471s, and he was audited, and then he was audited in 2017 from 2000 to 2015. So 15 years of 5471s, right? And the thing is, they weren't his accounts. So the IRS got a piece of paper that said his name, and there's a bank account, but they weren't his accounts. He didn't know anything about them. His dad was supposed to give them to him, but he never had control over it. So he goes, I really don't know what this is about. And so he was in a position where he had to prove a negative. Prove you don't own this. How do you, and so that's, so it does happen where the IRS will set you up for multiple years. And I think that's actually what's happening generally overall. IRS collection resources aren't there. IRS assessment resources aren't there. So they like to put you all together, let you build up a really, really big problem, then go after you. That seems to be what I see, is they give you enough rope to really, really hang you up. Clinton, what would you say about that?
Well, it's interesting. They did issue these back in July of 2019. They did it for 3 or 4 months, so about 20 or 30,000 of these letters went out, to our knowledge. And to everyone that got one, they all had in the neighborhood of $900,000 of crypto assets or more, so that they knew who it was. And they're now issuing a new wave of these. It started in December 2024. I am assuming roughly 10,000 a month are being issued of these letters, and they continue. Every month they've been issuing them. Now we know we've been able to determine where they've gotten the information. There is the largest crypto exchange was called Binance, and it operated internationally, most recently in Malta, and almost everybody had an account at Binance. They were the biggest and the best. And the US government, along with the Australian government, the Dutch government, the Canadian government, and the UK government all started filing lawsuits on Binance and trying to crush them. The US eventually crushed Binance because Binance had a US arm that they had created, and they caught them in a bind. Eventually, Binance caved. They put the president of the company, the CEO, guy named CZ, they put him in prison for 4 months for not complying with the anti-money laundering regulations. Now, 4 months, that's a light touch, all right? And the reason would be, as we expect, there's no reason they would do this if they didn't get all the data from Binance about U.S. persons. Now, you did not have to file KYC with Binance, but they could tell things about people. If you did a transfer in from a U.S. crypto exchange like Coinbase, or if you were using a U.S. IP address to interact, or if you sent coins from Binance to a U.S. Exchange address. These are all tip-offs of someone who's been trading on Binance. So we believe every single one person that did this all had Binance accounts, and that's why they're getting these letters issued.
Oh, that's where it is. Okay, yeah, no, Binance was, okay, so that explains it. So that there's an interesting thing. You have to be careful, and I think that this is the problem that people get involved in these cryptos that wind up being subjects of the Department of Justice, maybe for good reasons, maybe not for good reasons. Some of it, either way. But the thing is that is likely the way that they're going to get your information, is through prosecution down the road. So it's really something where they do kind of will be able to get this as they pressures. Now, you did say something very interesting. I'm going to ask John Richardson about this right now, because this might be a good segue. You said something about anti-money laundering. You said, hey, you know what? You're running afoul of anti-money laundering. Like, oh, that's interesting, because cryptos, aren't they property? I thought they weren't monies, but that's interesting. So John Richardson, thank you for joining us today. I want to talk about, and I think I have it as my next slide here. These are the versions of the letter, and you can see what they are. There's a soft notice, a little bit more, a little bit, it scales up, but this is what I want to get to. Hold on a little bit up here. Where is the letter? Okay, let me go back. Okay, it was this slide here. I'm going to go back and show you what I want to talk about now, because we have this IRS notice 2014-21. And this is where I said, I think John Richardson would have some fun with this one. So let me get this up. And there we go. Where'd it go? Okay, here it is. So this is IRS notice 2014-21. Okay, and this is where we find out that virtual currency is actual property, right? It's not a tax case. It's not a statute. It's not even a regulation. It's an IRS notice where we learn that a currency is actually property. And so this is where I found, as it's like, okay, well, let's take a look at how this happened. What's the legal basis for it? Well, the legal basis that is given is that it's really from here. It's from the general 26 U.S.C. Code Section 61, gross income defined. So it's basically here. It's this. This is where the IRS, and it's a really fun sleight of hand what they did. It's really fun what they did. They say, okay, general definition, except as otherwise provided in the subtitle, gross income means all income from whatever source derived, including but not limited to the following items. We could say gains derived from dealings in property. It's like, okay, I get it. But my question is, how do we know it's property? Where do we see that? What is it? It's like, right, you're saying it's property, but we need a law to say that a currency is property, because I go to here. This is the code on what legal tender in the United States is, and what, basically what it is. We get to this. We get to 31 U.S.C. Code 5103, legal tender. United States coins and currency, including Federal Reserve notes and circulating notes of Federal Reserve banks and national banks, are legal tender for all debts, public charges, taxes, and dues. Foreign gold and silver coins are not legal tender for debts. Okay, that's where we get there. And I'm looking at this and I'm saying, well, that's funny. It doesn't say, what we have here, John. Do you think I might have something here that there's actually no definition of what a United States coin or currency is? It just says it. It says United States coin or currency. I tried to find a definition. I couldn't find one. This is it. This is the definition, but we don't know what United States coins and currency is. We do know that cryptos are subject to anti-money laundering regulations. So it seems like it's money. So this is where I'm at, is that it seems like we have a leap. It seems like the government made a huge leap by discounting the fact that virtual currencies have that thing in its name called currency. But we're going to, and the whole reason why, and I think this is really the reason why this is all happening, is cryptos are really, and I think I have a summary up here. I thought I had a summary here. Cryptos are really, oh yeah, here we go. This is what I want to talk about. Cryptos only took off because the U.S. federal government has made sound money illegal. The Federal Reserve Act of 1913 made sound money illegal. It put it into the hands of private banks to create a private script that became, as we just saw, the law that says, oh yeah, by the way, Federal Reserve notes are also legal tender. So that, to me, because when you look at this, right, when you look at this back again, get this one back. Hold on, go back. Sorry, moving back and forth a little bit here. When you go back to this, we go back to the legal tender. Federal Reserve notes are but one type of legal tender, because it doesn't say Federal Reserve notes and circulating notes of Federal Reserve and national banks are legal tender. No, it says including. So to me, that says, well, there's this United States coin and currency. Well, what is it? Well, if it's something owned or created by a U.S. person, then I would say, oh, that should be a United States coin or currency, because there's no definition. All right, so John, what do you have to say about this? So here's where I'm going. Do you think I got anything here?
Well, I think that this kind of analysis is necessary. I think it's important because, it is important that the government is not allowed to, make up the law, sort of thing, right? So, I don't have an immediate response to it particularly, but I think that the point you're trying to make is that for these money laundering allegations, you have to be dealing with money, and I guess your point is that this may not be money or whatever, or that's part of the inquiry, right? But,
well, that's what Clinton just said. It's like, well, you're going direct to rect. You're going from you're not cashing out. You're just going from one to one.
Yeah. So here's the thing, though. Let's go to let's focus on section. By the way, that notice that you read, I think, has direct application to the FBAR case that's going on right now, doesn't it?
I'd say so.
Yeah, because that's the basis for the the allegation he didn't report enough capital gains. But I think probably the way that this would be justified, assuming you want to justify it, is that basically Section 61 is interpreted to make any accretion in wealth, so to speak, income, I think, right? Isn't it?
Yeah. Basic gross all income from whatever source of revenue, including but not limited to the following items.
Yeah. So, I mean, I think that's probably, as far as they need to go on the issue of reporting income or, taxability or whatever. Now, it may well be that to extend this into the area of money laundering, I don't know. I mean, I haven't looked at this. That may be a problem, or it may not. But there's no question that all roads lead to serious problems with this stuff. No question about it, because, unfortunately, the way I read Section 61 is that basically anything at all, can be treated as income. And, by saying in 2014 that they're going to treat this stuff as property is really to say that the way they're going to think about or categorize the income is in the form of a capital gain, right?
Right.
Would that be correct?
That's right. Correct.
Yeah. So I don't know, but it is very, very clear that this is an area where the law is playing catch up to the reality of life in the 21st century.
Well, I mean, yeah. Well, it's like you're saying catch up, but what it's trying to do is capture, because, again.
Yeah, absolutely. Anytime you're playing catch up, it means you don't have laws, and it means
Right.
you're making it up as you go along, and it means you're going to, find any way you can, okay?
Yeah.
Claiming somebody's run afoul of it. And it seems to me that, I don't know anything about crypto, full disclosure. Okay. So, I'm glad that Clinton is here today, and, I'm finding his insights very, very interesting. But, to the extent that this stuff is regarded as foreign, right? Plus the lack of clarity in what income is. And I would say you've got the perfect storm, when it comes to, penalties and enforcement. At least that would be my interpretation of this.
I think the notice 2014-21, I think the key thing there is it was pointing out that cryptocurrencies, what we call cryptocurrencies, what they called virtual currencies, are treated as property, intangible property. It's not treated as currency under the law that you just pointed out, Anthony.
Right.
That's the key thing there. It is not legal tender, even though the word currency is in the name. And so you've seen they've now moved away to a new definition. They don't use virtual currency anymore. They call it digital assets. Again, getting back to this whole asset motif. And I think it's true what John said, that the law is certainly playing catch up, because what we have is a new class of assets that just doesn't fit in to the characteristics of a stock, a bond, a derivative, or real estate. So it really pushes in a new frontier. Now, when it comes to the FBAR, money laundering regulations, what we're following is the instructions over from the Bank Secrecy Act, right? So we're looking at, I forget what it is.
31 USC 53, 31 USC 5314.
5314,
you're
paragraph
looking at
1010.
10.350, the regulation.
10.350.
Oh, 10, yeah, right, yeah.
That's what we're on. Now back into the FinCEN has expanded their definition to include virtual currencies under the reporting obligation there. The challenge, though, with the original FBAR filing is it basically talked about financial accounts as basically being in fiat, in cash. So, it didn't really talk about assets that were cryptocurrencies. It wasn't clear, but that FinCEN's cleared that up. When we come over to reporting obligations for Form 8938, we're led to tax, IRC 6038D, paragraph B2B, which says one of the reporting things is that any financial instrument or investment or contract for investment purposes where the issuer or the counterparty is not a U.S. person, that has to be reported on that form. I think it's section 6, part 6, right? So that's what we have to. That's where the anti-money laundering comes in. Is that a cryptocurrency is clearly falls into financial instrument or contract for investment purposes. That's a catch-all basket, and where the issuer is not a U.S. person. Well, no, these are all anonymously issued. They're generated by computer programs, so of course it's not a U.S. person. Now they've not enhanced they have not enhanced the law on 6038D to make clarity regarding the anti-money laundering regulations. But our company, we take the position of it's better safe than sorry to file that form.
Yeah, exactly. Right. And I would say, and I think that's exactly right. I question, and if you watch this channel, question the legality of the FBAR. We've seen this in the Doug Edelman indictment, that Doug Edelman was indicted for violating a regulation. And the reason why is because there's no law. This is the law, and we've gone over this multiple times, but this is the law, what the regulations claim. The regulations claims this is the law that proscribes an FBAR form. Of course, it's not entirely, of course, the Treasury's making it totally up. It's not true at all. Really, and John has gone over this a lot in detail, but 31 U.S.C. Code 5314 was originally part of the Currency Control Act. Imagine that. And actually, in a way, when I'm looking at this, I could see this, that the FBAR could potentially apply to cryptocurrencies far easier than foreign bank accounts. When I look at this, because when you actually look at what's going on, so here's the law, and the law was, again, the law was created to make the world an easier place. That's what, considering the need to avoid impeding or controlling the export or import of monetary instruments, and the need to avoid burdening unreasonably a person making a transaction with a foreign financial agency. There's your problem. You don't have a financial agency right there. That's sort of your first problem, and you don't necessarily have the import and export of monetary instruments. They could just be wherever they are. The Secretary of Treasury shall require a resident or citizen of the United States or a person in doing business in the United States to keep records, file reports, and keep records, file reports when the resident, citizen, or person makes a transaction or maintains a relation for any person with a foreign financial agency. So it's the transaction that's reportable, not the thing. And that's where, when I think in a post-Loper-Bright world, I'm hoping to pick up a client who wants to challenge this. Haven't done it yet. And it's just one of these things where you see this creep of the government creep, because, they're a little creepy. This is what they're going to say, actually, and allows them to penalize and ruin someone. This is the form. Have you heard this argument before, Clinton?
No, I have not heard that. I haven't heard it in terms of being transaction. When I read the instructions on the FBAR, they want to know the maximum balance.
Oh, of course, right.
And this is what's really peculiar. What's hard about this for the crypto investor is this tendency to move from one exchange to another. Like I bought this on this exchange, and I moved that coin over to KuCoin, and I bought that something else there. And so what happens is I might have, say, $8,000, right? The minimum threshold for FBAR is $10,000, right? So let's say I have $8,000 worth of crypto. I move it to Binance and I buy something, and now I move that over to KuCoin, the same 8,000. I take that coin, I buy something different. Now I have a total of 16,000, right? So now I hit the FBAR filing requirement because I have the maximum balances on these two accounts exceeds 10,000. Yet there never was $10,000. So again, it's one of these things where it's better safe than sorry. Over-report, exaggerate, overestimate. It's crazy.
Well, but this is true of all bank accounts. I mean, the basic principle, right, is you just look at if the aggregate of all of the separate bank accounts. I don't think that's a problem specific to virtual currency or whatever you want to call it. But I'd like to ask Clinton a question here, if I may. At what point, see, you seem to be fairly confident that virtual currency is reportable on the FBAR. Have I got that right?
Yes. FinCEN updated their rules, I think, in 2022 to include the virtual currency as part of the reporting.
Okay. So then that's relatively recent, if the change is 2022. Is that correct?
Right. Yes.
Can you, I'm genuinely interested. You may not have this in front of you, but is there anything you could add to that, like in terms of the exact language they've got on that? Or
I don't have the exact language.
Okay, that's
I'll try to pop up the FBAR instructions. Okay, I'll try to pop. Well, you guys are discussing. I'll
well.
try to.
Well, actually, let's not go to the FR instructions. Okay, let's go to the actual regulation. Okay, because I
Okay.
mean they can't. It's the regulation that's the key. I'm just trying to understand this because again, I don't live in the world of cryptocurrency, so this is not something I think about. But I do know that in relatively recent memory, okay, the consensus was that virtual currency was not reportable on an FBAR, but you're telling me that we have a change in 2022. Where is that in the regulation?
Here, I got the I got the regulations. I'm adding them. Let me add it to you. Hang on, right here. Here we go. That should do it. Here we go. Okay, here it is. Here are the regulations. Right, and here, this is what I say. The form prescribed is the report of foreign bank accounts and financial accounts, which it never actually does. There's nothing that says that. So they're making it up. This is the government making it up in typical ways.
Well, this is their view of what the law is, though.
Right,
This regulation.
Okay, here we go.
I mean, our position on it is these terms are very fluid. They're kind of inventing these words, convertible virtual currencies, and when is that and this, and they're trying to roll these words into the law under the as you say, as regulations or procedures. And it's our position is for our taxpayers is, our taxpayers, my taxpayers, are typically high net worth individuals, very high net worth individuals, and they simply do not want an audit. Anything that they can file that helps reduce the chance of audit, they're going to file it.
Yeah.
So, it's really not a matter of, it's a great discussion. Is it really applicable? I think there's just some gray here, but we just take the position of it's better safe than sorry,
Yeah. Well, yeah, that makes sense. That makes sense. I mean, I am not a tax preparer, as you may know, right? But my impression of this area is that there are plenty of people with whatever you want to call it. Some use the word crypto accounts that are not including these on FBARs.
75% of people aren't even reporting their cryptos. And of those 25%, there's probably less than 10% that even know about the FBAR and the 8938.
No question about that. But okay, but you're not. So I'm just trying to get clear here. I mean, was there a change in the regs in that regulation in 2022, or is this just sort of the evolving consensus of the best practice?
There was a document issued by FinCEN. I don't know if it was a procedure or if it was a regulation. I can't. I don't
that's what it is. Yeah, I'll try to find that because it's not.
If you can find that, I would love for you to send that over to Anthony, who can then send it over.
I'll probably be able to find it while we're discussing. Let me try. I'll try to find that while we're doing that. The thing I wanted to get to was that, and I mean, these are, and I would say, Clinton, I'm exactly in the same way. I think the FBAR is about as illegal as it gets, but in every case, I file it. Well, I don't want my client to be the guinea pig or any explanation. It's really more for the defense of someone who didn't file one. That's where the argument really is really powerful, and the IRS doesn't like to hear that. And that's usually when you explain to them, by the way, you have no authority to assess this FBAR penalty. That's when you're going to get a little bit of a different response from IRS Office of Appeals. They'll likely agree with you because they know they have no authority, and they know they don't.
The courts have destroyed the FBAR penalty assessment.
It's really something, and how awful it is. All right, so let me try to get that while we're going along here while I'm multitasking.
I can give you a nice, if you like. This is a really hot topic about these letter 6174.
Yes. Okay.
This is extremely hot. I mean, as we get out of the weeds here, this is extremely hot. We're talking about a Supreme Court case now. So there was, as you read, the first 6174s were issued, 6174, 6174A, and 6173. These were issued back in the summer of 2019. And if you read, if you show it, it basically says, we know you had some cryptocurrency accounts. That's like the first sentence. And maybe you should just check to make sure you reported it. That's what the letter says, of course. But if you get a letter from that like that, it's terrifying. It feels like an audit. It scares everybody. Here's what happened. At this point in time, we're probably in the neighborhood of 70,000 letters that have been issued at this point, and it continue to grow. There's been a court case filed, and it's now risen up to the Supreme Court, Harper versus Commissioner, and it just got filed, I believe, last week.
Oh yeah, here it is. I think I have a little bit of news. I can probably pop this up.
Yeah, Harper got a 6174A letter. That's all he got. Now his position is the IRS has illegally obtained my financial account information from Coinbase when they got this, because they're under the Fourth Amendment. You got to have a reasonable basis for a summons or a search warrant, and they're basically saying IRS had no reasonable basis. They were just collecting information and got it out of Coinbase from a lawsuit. So they're saying that was illegal obtained. Now, jump forward to what's currently happening. It's information they got because they sued Binance, and part of the negotiated settlement was they got this information. Would that be considered legal evidence under the Fourth Amendment to be used against the taxpayer? And can you actually issue one of these letters? I think I'd be interested in your thoughts on how that would go down.
I did read that briefly, and I was excited. I loved it when I was reading it. I really loved the suit. That's like, you know what? I'm just offended you sent me this letter, and I love, and I'm like, there you go, right on. I think there's a really good point there. It's like, well, you got all this. And I think we could see what's happening, because this is why the government wants to go after all these cryptos. Not necessarily they're going to get it, they're just going to get information, though. This is another way we can get information on people that we otherwise don't have a right to know. And so it does seem that way. And I mean, the whole point, people don't want the government to know. And this is what I had in my slide here. This is the point I want to make. The price of Bitcoin is inversely proportional to how much faith people have in the U.S. government. That's exactly what it quantifies. How much distrust people have in the U.S. government. And that's really what's driving it. And, all of these government actions aren't really building the trust. They're just building the force, right? They're not really, well, you're not really, okay, we could trust you to hate us. And that gets me to my point here. And this is an area where we see the overlap. This is what I want to get to. John Richardson's, I don't know if you've seen this before. John Richardson's points of hate theorem. I do believe it's a theorem, technically. And this sort of depends on, to know how bad your U.S. tax treatment will be, you have to add up your points of hate. Okay, how much do you hate? Being a U.S. person, point of hate. Being overseas or being a foreigner, that's a point of hate. Marrying a non-U.S. spouse, point of hate. Owning a business or otherwise creating something, that's a point of hate. Having something the government wants, that's a point of hate. Being in the way of government somehow, making more money or having more money than a government employee, being young, that's a point of hate. Being old, it's a point of hate. And also just you add them up, now you know how complicated your tax return is going to be. Now you know what the penalties regime that you're going to be subject to. This is so this is our theorem. So what would you say? Would you agree with any of this? And are there points that you would add and clarify?
As I like to tell my clients, the last thing you want is your face on an auditor's dartboard.
Yeah. And it's not a lot of fun, and I think you get a wide variance of audits too, and I think that's one thing that's happening right now is the IRS audit division is falling apart. Audits, I think I have an audit where the third examiner's on the case because they keep on getting fired or they leave, whatever the case is. But right, you don't want to be there, and that's the point of hate. And I mean, that's the thing. You really don't want it, so we're going to overfile, and maybe you'll even pay more taxes than you need to because we're afraid of that audit, right? Is that kind of what you end up with a lot of times?
Well, we do. Well, I mean, people usually pay less because we do a better calculation of their capital gains than they can do themselves. I have a company of 25 employees, and half of them are forensic accountants doing gain calculations. So I can tell you some interesting information. The IRS is shifting its strategy for audit on cryptocurrency people.
Okay.
In the past, they said, give us all your transaction records. We'll recalculate the whole number and tell you what you should have reported. Now, this got to be very problematic when people had more than a couple thousand transactions because they would calculate it wrong. And my company, we personally have destroyed the IRS's confidence in doing this. One of my cases it was a court case. It was the first time that they threw it down to appeals. Appeals brought in an outside consultant called TaxBit, and they did their own calculation. My forensic accountants ripped it apart. They recalculated again. We ripped it apart a second time, third time, fourth time. And now we're at the point where they said, we had this just Monday. The appeals officer said, it's well known all about TaxBit's problems. I mean, so appeals is basically backed away from TaxBit. Here's their change of strategy. What they're doing is the regulations for how in the IRM, the Internal Revenue Manual, said they're only supposed to sample the accounting, not redo the accounting. Okay. So they realize that they're off, and they've taken a different approach. They basically are going to pull out 10 transactions, and they're going to say, prove the cost basis on these. Now, think about this. Which ones are they going to pull out? They're going to pull out the ones from finance, all right? Because these are the ones that people aren't reporting. A lot of people would report their U.S.-based exchange transactions because they're U.S.-based and somewhat reported. But the foreign ones, they weren't reporting. So they're going to pull out a handful of these sell or exchange transactions on Binance, and they say, show us where you reported the cost basis in your tax return. Now, this gets you into a pickle. If you're the type of person that did a crypto tax return where you just put the bottom line, net proceeds, net cost basis, net gain or loss, and you didn't give the detailed line items, well, then you're kind of exposed. If you did give the detail, now you're going to have to actually show, oh yeah, it was this one on the 8949, page 2, that one, that was the one from Binance, and here's the cost basis, and here's where I got that information. That's what you're going to have to do. So this is a much easier standard for an everyday auditor to do. Okay, and it's quicker. It doesn't require recalculation and all the mess of that. So these 6174 letters are going out. I do believe that they will go back and do some audits of these. Very simple audits like this. It requires very little time for the auditor to do it. So either you got the information or you're going to start like blathering off the mouth about excuses. And at that point in time, then they're going to turn it over. Now, the second step is this. I think the next dimension is they're going to turn these crypto audits over to criminal investigation. With criminal investigation, it's much, much easier to go after a crypto investor than audit. With audit, we're dickering over what is the right number. All right. With criminal, all we have to show is that you didn't report the income. And the threshold is very low, although the courts would want a much higher amount. But you have to show that you had some gains and you never reported them. And that's criminal. And we're indicting you, 15 counts of whatever, and you're going to go to prison for the rest of your life. And the next step is you get a criminal lawyer like yourself, and then, it's just the plea bargain, right? It's like, we're not even going to argue the gain calculation. You're straight into plea bargain at that point. Plus, with criminal investigation, they get the $250,000 penalty, and you're still going to pay all the taxes in the past because they don't want to be hit with civil fraud later, right?
Well, and and you're absolutely right. It's one of the worst places to be. The criminal investigation is absolutely frightening, and how the IRS works. You said so much in a little bit of time. Thank you so much. First thing I want to comment on is, one of the things people don't realize is that the limitations of the IRS. They think the IRS can audit everything. And it's not even true. Now, what the IRS can only do is audit what is simple. Okay, the number one, there's two most common audited forms the IRS audits are: number one, earned income tax credits; number two, Schedule C. Those are the two things by far. About 1 in every 100 of those are audited, because you know why? It's easy. And the Schedule C cracks me up because it's easy enough for a small business person to fill out. It's like, well, that means it's easy enough for the IRS to audit. That's the thing. So oftentimes I do suggest people getting to S corp or partnership to lower that audit risk. But there is a real limitation, and when you want to know that I got just added. Good morning, Borchell. Yeah, watching IRSMedic might be a double A point. Thank you for that. Andrew also. Andrew, thank you so much. Our common law wizard, Andrew Prune, showing up. Money is a property, right? And his income is divided. Yeah, I know that we got that. I'm going to go. I'm going to circle back to Title 61 or Section 61. I'm making a note of that because there's something I want to hit on that, Andrew, before we leave. So thank you for that. But the IRS will audit. What is easy and a good way to know is to say, does the IRS have a practice unit on it? And what that means is there's an audit guide. And auditors, there's so many misconceptions about auditors. Auditors are looking at your return not as a tax preparer, but as an auditor. And I think that's where people, go off the line. They're like, no, they're not looking at it the same way. And a lot of times it's really the image the IRS is trying to present is something of all powerful, almighty. But the fact is they're incredibly limited. I've seen the quality of their appeals go way down. Unfortunately, we just lost another great appeals officer. She retired as well. I'm seeing their quality employee go down. And one of the things that I discussed this with one of the topics of discussion I have with my father is really what happened to the IRS. That there's the rise and fall. I'd like to get your opinion on this, Clinton. The rise and fall of the IRS. The reason why the IRS was able to grow so spectacularly, and really, if you want, back in the day of from 1980 to 2010, the IRS was an incredibly, what it was able to accomplish and what it was able to get out the other end was actually incredible, whether you like it or not. You got to say, wait a minute, that was an incredible organization. What allowed it to grow to its lengths and its power? We've seen it because we've seen it fall off. And my theory is the number one person responsible for the IRS becoming the behemoth that it is and being able to do so much is no one else other than John F. Kennedy, who inspired a generation more with his words, ask not what you can do for your country, what your country do for you, what you could do for your country. My dad said that is why he went into public service himself. And he said, look, I went to Brown University. I could tell you I had a whole bunch of classmates of mine who went into public service, whether working for the federal government, states governments, anywhere. There was so much talent that went into the IRS because these were guys who believed in America, who had things they could do, but wanted to do this because they believed in the mission that much. And from what I've noticed, those guys started retiring 2007, 2008. That's when they started retiring. That's when I've seen, whoa, we're not dealing with the same level. And I think the thing is, it's not necessarily a knock on who's at the IRS now. It could be more on complimenting the people who were there. Like there were some incredible people. So what are your thoughts on our discussion here?
Well, I think that's an interesting observation in discussing why there was an underlying motive for doing some quality work. Plus, it's a very exciting time. I mean, the IRS is a massive data center. I mean, they use a lot of computer technology, and computers usage was exploding from 1980 up and through at the time frame you mentioned. I would say that they started using 1099s. They started doing covered trade reporting, which made brokerage reports easier, and taxes were simpler. The people that made the tax code complicated is Congress. All right, it's Congress that said, oh, maybe we should phase this out because we don't want the rich people to get too much of a benefit. Maybe we should phase this out. Maybe we should phase that out. And pretty soon, and maybe we should index this every year, on inflation. And pretty soon it's like, the accountants have no idea what the itemized deduction is for this year because it changes every year and everything is so indexed. You have no idea. Customers come to you and say, well, if I do this, will it reduce my taxes? You go, there's a lot of factors there. It's not simple. You go to other countries, it's not like that at all. It's really flat. In England, the tax rate goes from 0, 20%, 40%. Bang, that's it. You hit a certain level, all of a sudden you jump up to a 40% tax bracket. We have, we have 7 or more, plus we have NIT tax and we have other credits and stuff that go and complicate the whole matter. So I think it's Congress that has made it complicated. The second thing I think that happened was the politicization of the IRS, with the whole Lois Lerner affair, with the Obama, what the Obama administration did with that, and then continuing to, pretend like, oh, we lost the emails, we lost the hard drive, crash, can't recover it. This whole politicization still continues. I mean, this year we have I think we have 6 IRS commissioners. 2 of them, allegedly resigned because they refused to support the giving of information to ICE for, checking illegal. I mean, that's political grandstanding. There's no place for that in the IRS, but yet you saw it in these political appointees. So that still permeates this politicalization, deep state, what do you want to call it, still permeates the IRS. It'd be interesting to see if you can, if they can clean that out.
I don't think so. I think I have a much more cynical view on it. But I would say that we did see the IRS actively covering up for Hunter Biden, actively,
Exactly.
and getting we saw that, so we know it goes on. And I happen to know of a few other cases where politically powerful people evaded massive amounts of taxes, massive and very clear, very obvious whistleblower reports came in. And in both instances, both of the whistleblower reports were suppressed. Even though I looked at, I know they were, I didn't submit them myself, but I know both people, and I saw both of them go away. And both families that the whistleblowers were against were millionaire, not related, but both were billionaire families. If you guys, and the evasion they did was pretty low level. I mean, it wasn't really that complicated. It was easy to find. And the IRS, and then we see the whistleblower division really covering up for them. So that's one thing that I guess I'm seeing that it's a little bit of sideways. One thing I did want to clarify, though, and Lou right here has a great comment, and I think we just want to clarify what I said, because when an account is only a virtual currency, right, then it doesn't have to be reported for an FBAR, because what we're dealing with, let me get John back here. What we're dealing with, there's right, it's a wallet. If it's in a wallet, it's not really a foreign bank account, right?
So the problem here, I think, is everything that everybody is saying is absolutely true. But the point is the income tax has to go, right? Because what it has become primarily is a system that is so that it can be understood by almost nobody. And everybody is out of compliance in something or another. So it's just become a question of, who they're going to go after and for what reason. It is simply unbelievable. I mean, Clinton makes the point, he compares it to England. Well, I know the Canadian system, and the taxes may be higher, but it's a lot simpler. I mean, people don't have to devote, this amount of time in their lives to trying to comply with this thing. And I think that largely these things are symptoms of a system that has far outlived its purpose and usefulness. I mean, we are dealing with a tax code with from really a 1950s perspective, okay? In 2025, it is entirely unsuitable. And it would appear that there are all kinds of vested interests out there who, want to keep this thing intact. And, again, the time has come for the income tax to go. I mean, there are certain states that are taking a leadership role in this. You'd be better off, just requiring every American citizen to do a month of unpaid public service in exchange for this. I mean, the thing has gotten so insane.
Yeah, I would jump at that.
We're talking about, this FBAR thing today, and, 8938, and, this and that. And, I would say that although there's a lot of intelligent discussion going on here, I mean, I think that there is far from firm 100% agreement and understanding in terms of how these things comply. Because, I mean, if you're at the point where, you're reporting things where you're unsure of whether they legally have to be reported, to avoid an audit or something. I mean, you are simply trying to avoid basically, and what is it I've said before? Certain penalty for uncertain conduct. I mean, that's what this is about. Certain penalty for uncertain conduct. I mean, it's got to go. This whole tax system, the whole method of taxation, the role of taxation, this has got to be rethought for a 21st century digital world. And even look at the results. you've got a system that is primarily taxing conventional income work. When fewer and fewer people get their income from that, you've got a system that, taxes people who go to work and sweat all day higher than people who, get their.
Sitting around the pool.
I mean,
right,
I'm the
yeah.
furthest thing you could find from somebody on the left of the political spectrum, but this is absolutely insane.
Well, and Clinton, this is about, you take over a lot of cases, I imagine. I imagine you've seen a lot of the returns other firms have done, right? And and I would imagine you kind of have the same thing. You see smart firms make terrible mistakes. Is that something you would see where
the big accounting firms have horrendous experience in crypto?
Yeah, right. Yeah. And I think, Clinton, that's the point right there. There you go. That, there's smaller firms like us out there who kind of get it and are, I think pretty sharp and on top of things, but we're it's like we're the exception. We're the exception. We just have the knowledge, the passion to do it. But you see, and I don't mean this in any way, but I've seen really good CPAs totally blow it when it comes to foreign reporting. Like, why'd you do that? No. And I'm like, oh, no. So it's one, and I think there's your proof how bad it is when really good tax professionals make mistakes, big ones. It's crazy. Yeah. So any of the big mistakes that you happen to see, and the big four, we always like attacking.
Yeah, I mean, the big companies have no idea about personal crypto investment. I mean, we've done over 50 audit defenses on cryptocurrency, 5 tax court cases.
Nice.
That's all our niche. I mean, we're so far down into that niche. We would work with a firm like you. You'd represent them on the legal side. We would do all the crypto and analytics. I'd like to comment on what John was saying. Philosophically, yes, we do need the U.S. government's reliance on income tax needs to change because we're having because of the population reduction at the lower age groups. We're having fewer and fewer workers, and they're being replaced. They're going to be replaced by robots, and you can't tax the income of a robot because they don't have any. All right. So this is going to massively destabilize the source of income over the next several years. So while it might still work for some people, it needs to be diversified. Secondly, we are in a rapid transformation of the economic system where we're moving from fiat currencies to, I'll call them blockchain-based tracking. I mean, international movements are going to be done via blockchain movements on cryptocurrencies. We won't call them cryptocurrencies anymore, virtual currencies. But really, fiat transactions on SWIFT are going to disappear. And everything's going to be blockchain-based. And pretty soon, you're going to be doing blockchain-based transactions where, when you go to buy something at Walmart, it'll be under your credit card. It's going to start using blockchain to interact with Walmart to shift the funds. Do I have to report that on my capital gains tax? Am I going to have to get a 1099 on this? And so, because you don't have this problem with stocks and bonds, but with digital assets, we're basically restructuring the entire financial industry. And you cannot try to do capital gains on that many transactions. The IRS simply can't do it. Technically, they can't do it. Yeah. They can't handle it.
So well, there you go. Well, now you're wow. That is. Yeah, go ahead, John.
Yeah, what they could do is simply put a transaction tax on, any purchase, etc. And
that's called a sales tax.
A very small tax, for the movement of money.
That'll give them ideas. Yeah, that's going to be a nasty. Yeah, no, I think you're right. Yeah.
That's what Billy Long proposed. He said, get rid of the IRS and get a national sales tax.
Hard, okay, but I mean, it could be massively expanded. Okay, any transaction.
And then I wanted to move on.
What's the alternative?
Go ahead.
Well,
there's no way that the income tax can continue. It's actually finished. It's just the obituary hasn't been officially written.
I'm kind of with John on this, and I think and I think in Clinton, I think you just
Look at the
explained it
point that
why.
Clinton makes, right?
Yeah,
About,
exactly. Well, Clinton just explained why it's kind of over. It's like, well, look, when we're talking, if the IRS, you bit off a lot by claiming currencies are actually property. You bit off more than you could chew. They really did because, okay, let's go. All right, let's do it then. Let's do it. So let's have every single transaction be some sort of capital gain. You can't keep up, right? I mean, there's no meaningful way. So it's like that. It's like, that's what you want, guys. Okay, here it is. Now you have a rule you can't possibly enforce. You can only do it arbitrarily against a few people. Meanwhile, everyone knows you're just making an example out of them, and they just know not to be as big as, not to be as big of a fish, right? That's really all you get. That's really all you get to. So that's what I would say, Clinton. I think you're describing sort of the end of the IRS as like, well, look, this is what's going to be happening in the future, and it's happening to a degree already. But it's only going to happen more. And so I say, yeah, what are you going to do? You have too many, you're not going to put these on a Schedule D. I mean, your Schedule D would, from here to eternity. Really. So I think that's the thing. It's like, they don't realize what they did. It's like they boxed themselves into a corner with this tax treatment. The IRS might want to not to claim its property anymore. Anything to say? Anything on that?
Well, I'm not going to give the IRS any ideas because this is how I make my money.
Yeah.
No, I think I mean, hey, look, Eric Trump, President Trump's son said in Dubai at the Bitcoin conference in Dubai last year that he said, "What about this?" Now, think about this. He proposed that there'd be no capital gains tax on U.S.-based blockchain or crypto projects. All right, think about that. U.S.-based. All right, and Donald Trump has said he wants to make the U.S. the cryptocurrency headquarters for the world. All right,
yeah.
So this is interesting. Now think about this. So let's say you passed a law and I have to imagine that if he's talking about it, Donald Trump is thinking about it too. All right, so let's say a law gets passed like that. What immediately happens is this. U.S. companies will start to tokenize every cryptocurrency that's outside the U.S. It'll all get tokenized. And once it's tokenized, it now exists as a U.S. token, and it will not be subject to income tax in the U.S. under that law. Secondly, in the U.S., we would tokenize every other asset in the world. All right, so you got a hotel in Lisbon, and you're going to change the ownership so it's owned by a token in the U.S. Now, when you sell it, it's a non-tax transaction in the U.S. So it will not be taxed back in Portugal because Portugal never know that the ownership changed. All right. So what'll happen is virtually every asset in the entire world will now be tokenized in the U.S. And in effect, the U.S. would own all the assets of the world, and it'll all be tax free. Everybody would want to do business here.
Oh
this is what would happen. Now, do I think there's a long way, there's a lot of opposition in Congress on this, but you can kind of see where that goes.
Yeah.
It would turn the U.S. into an even more powerful financial powerhouse. In doing all that, if you just somehow maybe it's not tax free, but maybe there's like as John suggests, some sort of mild transactional fee that's going in there, a 0.5% or something, and everybody would accept that. And plus the fact that the U.S. is the biggest tax haven in the world for everybody in the rest of the world, they'll never report these things back. I mean, this is the vision that Donald Trump has, and it's actually quite powerful. And it would put the IRS out of business because there wouldn't be any tax on U.S. and any assets. You sell real estate, it's a tokenized asset. No tax on that. I mean, it would totally cut the knees out of the IRS on a big chunk of its income source.
Oh my God, I see. Wow, there's unintended consequences. I got to say, we got a great audience today. We have a lot of people, a lot of new viewers. A lot like Lou is a big fan of yours. She's been working with you. I guess she's been working with you. So I'm so excited because as we're talking about this, I realize I really have I have two, incredible guest right now. Keith did have to drop off, but these are the people you need to listen to. This is a great combination here. This is where it's going. This is where things are. This is where it's going, and it's just incredibly fascinating. Now, one thing I did want to hit on, one of my little pet projects before we turn it off, and we, by the way, I do want to get the comments. So if you have your comments, we are getting to them. So this is what I wanted to get to right now, and this is sort of the problem that I have, and I think what we end up with, and really one of the big problems with the income tax is how poorly it's written. It is written so incredibly poorly, and the first thing that you have is a nested. You have a tautology immediately. Gross income means all income from whatever source derived. Okay, so my son was telling me, I was showing my son this the other day. I said, hey, just take a look at this. What do you think of this? He goes, well, my 8th grade teacher said that if a definition includes the definition, the word in the definition, then it's not a definition. And I'm like, you're exactly right. That's a tautology. And then when we get to here, we also, they do it again. Gross income derived from business. So what's business income? Well, it's gross business income derived from business. That's the definition of what we have. But, this is what's written. And I mean, this is, from that, like, this is so poorly written. And I think that's one problem. That what can you really expect? What can you really expect this tax code to be when it is written so poorly and there's regulations that allow them to do kind of whatever they want? I mean, this is not, and I mean, that's the thing. And then, like, what is the test for income? And you go to the Glenshaw Glass test, you're like, okay, is that it? Like, well, no, not really anymore. And then it's, from Moore versus United States, for Moore versus US, you could have a retroactive tax on income you never receive. That isn't even your income. And that is included as gross income because that's what you have. And so what I'm getting is from what you're saying about, look, this is how transactions are going to go in the future. We're going to have these transactions going this way in the future where everything is a blockchain. We're going to have millions and millions of daily transactions that won't be able to keep up. And it's sort of like we have an outdated, obsolete tax code. Basically, I mean, here it is, right? You haven't defined things. And you're letting it up to the government, and then when the government does go and define things, they haven't thought it through. They haven't thought it through about, well, what happens when you're treating all these as property. Any thoughts on this little sort of problem, fundamental problem?
Well, you're right. I mean, it is, it's hard to be the first person to write statutes, right? So they've written this, and of course, then it goes to the courts. The courts interpret it, and we got, of course, the Glenshaw Glass case, which whenever the IRS issues an opinion or notice, they always quote Glenshaw Glass, and the reason is because the judge so severely overstates the case. Any gain clearly recognized, and ascension to wealth, clearly recognized, blah, blah, blah. Well, in the Glenshaw Glass case, the guy got money. He got cash, or the company got cash. And they just chose not to report it because they didn't think it was a reportable piece of income. But the IRS quotes that all the time as though that's the definition of income, when in fact it's an overstretched definition they've tried to apply in so many of their cases. This is actually subject to there's a court case on this. It has to do with the tether staking cases. It has to do with at the very beginning. It says any income from whatever source derived. Now, there's this thing in cryptocurrencies called mining, where you are, in doing work, you get rewarded through the protocol, you get additional coins, okay? And these coins never existed beforehand, and now you are the recipient of it because you have contributed to the overall effort. And the IRS has said that's taxable as ordinary income at the fair market value, US dollars, at the time it's received. And this is being challenged because their argument is a baker bakes a cake, all right? Is he taxed when it comes out of the oven, or is he taxed when it's sold to a customer, all right? He created the cake, but he hasn't made income until he sold it, all right? And this is a subtlety that the IRS is getting tripped up on, and there's court cases at the appeals level to do this. So, there's a bunch of cryptocurrencies challenge the whole concept of income because first of all, it's all intangible, and it exacerbates a lot of the issues in the tax code, which are based on dollars moving between people, and that currency is somehow different than property. And here, we're in a world where cryptocurrencies replace dollars. So this is where we're headed. A lot of interesting things. It's what we want to. We should talk again. The U.S. Treasury Department will be coming out with regulations very soon.
Okay.
They were given 6 months to put together new regulatory format for cryptocurrencies and how the U.S. government would regulate it. I expect there'll be something on tax in there. And there's a bill in Congress right now called the Clarity Act, which is also called the Market Structure Act, which talks about how cryptocurrencies are regulated by the SEC and the Commodity Commission and these sorts of things. A lot of developments happening, but we're in a very active time, and there's a lot of interesting things happening. And we should also talk again because the 1099 DAs are going to come out, and it's going to cause absolute pandemonium for people.
Oh boy. All right. Well,
yeah, we'll talk about that. We need to talk about that.
All right. Well, we do have to wrap it up. John, what would you say? John, what's your takeaway from today's topic on cryptos? Do you see any overarching theme going on here?
Yeah, absolutely. All roads lead to renunciation. As confirmed by Clinton. There's no question about it. Nobody can live with this kind of certain minimum penalties for uncertain conduct.
And I think that's really why you see the Roger Ver prosecutions going on, so that crypto guys don't. You basically you're going to do that, and I mean it's totally, an invented case. We do wish Roger, incredible, and he's got a great team. I got to say, Rogers has a great team, and he's doing a lot of smart things, and he understands this is a PR battle. That's really what it is. The government's trying to paint him as this.
It's far more than that, Anthony. It's far more than that. I mean, that case incorporates a lot of the things that we've been talking about this morning. Huge problem. But, what is clear is that, look, once a society reaches the point where thinking about taxation and dealing with compliance takes up the amount of time and causes the amount of anxiety that this does, coupled with the fact that this is an attempt to apply a 1950s tax code to 2025. The problem is not American citizens. The problem is the tax code. And all this energy that's going into harass people, keep the level of anxiety high, basically put tax preparers in a position where, if they're really honest, they don't know the rules. And, nobody can know the rules. Therefore, they don't know the rules. So their goal becomes, let's make a judgment call about whether to report this or that, to keep the person from being audited and penalized. This is an absolutely intolerable situation. All that energy needs to be redirected to a recognition the income tax is over, what's going to succeed it. And I'll say it again, you'd be better off requiring every American citizen to do a month of national service cleaning the streets.
I'd love to.
Than having them be involved in, this ridiculous exercise.
Thank you, John. And by the way, if you are thinking of renouncing citizenship, there's no one better than John Richardson. You could reach out to him at his site, the Citizenship Solutions at .ca goes right there. Also, or you can email him directly at citizenshipsolutions@protonmail.com. And I want to thank, and Clinton, what's your Twitter handle? I didn't put that in here. Let me get that in here.
On Twitter, Crypto Tax Fixer. Crypto Tax Fixer.
Oh, okay.
And we have a YouTube show where a lot of our videos end up on Twitter on YouTube.
I'm going to be on that.
Donnelly show.
I think I'm going to be on there. Yeah, I got to be on there. I want to be on there. Yeah, I can't. So let me get here. There you go. So here's how you can find Clinton at cryptotaxaudit.com at cryptotaxfixer. That's how I met him on Twitter. Saw some pretty intelligent things there. So really, really appreciate that. So I think we have a friendship here. I think this is the beginning of a beautiful relationship.
Great conversation.
Absolutely. Oh, we got a couple more questions. Let's see what we got here. Genius Act Senate passed. I think
the Genius Act is an act that allows stablecoins to be issued by a lot of people. And what's going to happen is it's going to cause a purchase of a lot of the treasury bonds to issue stablecoins.
Okay. Oh, and here it is. Here's your show. Okay, right here. Perfect. Great. Thank you so much. All right, there it is. Clinton Donnelly. All right, great. Looking forward. All right, that's fantastic. It'll be a lot of fun. Oh my God, that's going to be great. All right, so I can't wait to be a guest on that. And I do just want to thank everyone so much. And I see you did have a lot of your followers join us today, which I really appreciate.
Thank you.
And I would just I do appreciate when people use our firm we do a lot of international tax prep, and we do a lot of, and that's really our specialty is crypto in the offshore world. We don't do that in the various controlled foreign corporations and all that fun stuff. So that's something we like helping out there with. So if that's something you have, you could just email me directly. It's probably the quickest way to get in touch with me. And with that, and I do want to thank Keith Redmond. He did have to pop off. Keith has been doing a great job getting people interested in this taxation, really on that personal level. He does that on his Facebook group right there at American Expatriates. So if you are living overseas and you're married to a non-U.S. spouse and you're just dealing with this and it's driving you a little nuts, you can find a little support over there. People get what they really do, and Keith helps people to guide the right way. So with that, I want to really thank all the guests today. And again, Clinton, it's short notice too. I mean, very appreciated. So much for joining us. And again, so thank you everyone. And be sure to like, share, and subscribe. It does help get the ratings up there, which we get this message out there as it needs to be. This is Anthony Parent for IRSMedic. Thanks so much for joining us today.